Hi, everybody. I'm Jerry Cronenberg, Director of Financial Content here at Moomoo Technologies Inc. And I'd like to welcome you to a very special webinar with a very special guest, our own Justin Zacks, Vice President of Strategy here at Moomoo Inc. Justin, good morning.
Good morning, Jerry. How are you?
Just great, thanks. So today we're going to talk about two very key issues in the market that have just come up or are coming up and how they might play into your investing journey. Number one, the Jackson Hole meeting of the Federal Reserve, which happened on Friday with a key speech by Jerome Powell, the chairman of the Fed, widely watched by the market, had some impacts on Friday, may have more impacts in the days ahead. And the second one is a big event we're going to look at this week, the earnings of Nvidia. Nvidia, of course, the very hot chip company that Wall Street has been in love with for some time, and its earnings results will very likely have impact far beyond Nvidia into the markets in general. So Justin, welcome. Justin is our strategist here. He will help us figure all of this out. And before we get started, I'd like to mention this is an interactive video. We'd like to encourage you to send in your questions using the chat function here, and we will try to answer them on air. So this is your chance to get Justin's expert advice and opinions here. Justin, let's get started with the Fed meeting. So not everybody watches the news as closely as you and I do. Not everybody follows every nuance of the market as much as we do. They've probably heard this name, Jackson Hole. Why don't you just view from 10,000 feet it and talk to us about what exactly is the Jackson Hole meeting? Why should investors pay attention to it? What's going on there? Give us a 411.
Thanks, Jerry. I think a lot of people, even that do follow the news, might not understand kind of the history of this the Jackson Hole meeting, what it is. So every year since 1978, the Federal Reserve Bank of Kansas City has sponsored an economic symposium to address economic issues facing the U.S. and the world writ large. And in the past, when it first started, and just to give people, a reminder, the Federal Reserve Bank of Kansas City is one of 12 regional Federal Reserve banks. So this is not sponsored by the big, FOMC. It's one of the regional banks, and at other points, other Fed Reserve banks have had their own symposiums, but they've never quite caught on. So they originally had this, in Kansas City because that's where their district is headquartered, but as they went along, when Paul Volcker was the Fed chair, he was a big fisherman. And they said, well, how do we get Paul Volcker to come to our symposium? And they said, well, let's move this symposium in our region, but a little bit further away to Wyoming, where there's quite good fishing nearby. And so that's why they moved it there. And you have the beautiful backdrop of these mountains, and you have great fly fishing in that area. And ever since then, it's been there. And so when it first started, it was kind of very much closed doors, a lot of eco speak, a lot of economists talking very theoretical type, academic type stuff. And then it kind of has morphed with some of the central bankers giving speeches. And in 1989, Alan Greenspan, who was chairman of the Fed at that time, started the tradition of the Fed chair giving a speech. And usually the speech is a broader policy message as opposed to something that's focused on a particular Fed meeting. It's more about, here's the path we're going, here's the path we were on. And they've been doing this every year since. And the last kind of really one of note was in 2022, when you had the current chairman talk about his pledge to keep fighting inflation, and we saw a big market downturn.
Wow, great. So, of course, we got a fair amount of news with this Jackson Hole meeting. Of course, everyone's been watching very closely what the Fed is going to do. As you said, with inflation, with rates, now we're talking rate cuts as opposed to rate hikes. So what did we get of note this time around? And what should investors, in your opinion, be keeping an eye out for or have listened for that they can use going forward?
Yeah, I think this time, in 2022, it was, we'll do anything to fight inflation. We're going to keep on it. And in this meeting, we saw a real pivot. So we've seen the time has come for a rate cut. And so inflation is nearing its target. Employment is cooling. And so I think that was the big message that the chairman sent. And I'll read a quote. Probably one of the more important quotes from the speech was, "The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. And so he's really talking not just about one rate cut, that direction, meaning they're looking to move towards a new cycle, a rate cutting cycle that may include more than one cut. And so not only was there this pivot away, towards cutting, but there was a pivot in their dual mandate. And to remind everyone what that is was when, kind of the Fed for a very long time, their main onus was to fight inflation and use rate policy as a tool to do that. And recently they added unemployment as their mandate as well. So now they have a dual mandate to keep unemployment low and inflation low as well. And so to do that, they have to balance it. So sometimes stuff gets out of whack, like inflation got really out of whack in 2022. And so that became a much bigger deal. And so now it's starting to balance and almost starting to move towards unemployment being a bigger problem than inflation. And I think you saw the chairman talk about that and speak to that, that the Fed is starting to worry a lot more about employment than they are about inflation. So in a way, this speech was almost kind of like a victory lap over inflation, even though he didn't quite say that. Hopefully that won't come back to bite him in the future. And he also, again, kept it a little bit vague. He didn't say when exactly these rate cuts are coming, but he really did kind of talk about that September timeframe and how and what that destination was. The other part of it was, I think he had been very conservative about his view on inflation in terms of having, tamed it. And I think there was an increased confidence that inflation is really moving in that right direction. Doesn't mean it can't move back, but I think that was the tone that was also very important in this meeting. This speech.
Great. Well, we're getting some great questions in. Keep them coming. We'll be getting to them in a minute, but let's ask you a few more view from 10,000 feet point. So what do you think all this means, looking at history, looking at what tends to happen to the Fed's rate path and to the markets generally? What do you expect is likely to happen here, given, again, historic norms?
So what, you have to look what Powell didn't say. He didn't talk about being gradual with any of these cuts. He wants to leave that optionality open. And if you look at, I like to look at the market pricing. You could say what he says, and you can also look at what the market's pricing. And the pricing didn't shift that much. So if you look at how many cuts were on average expected before and after the meeting in September, right? Before and after the speech, it was 1.25 cuts. Now it's 1.35 cuts. That basically goes from 31 basis points to 33 basis points on average. Not really a big deal. What's really interesting is by end of year, they're expecting, before they expected about 3.9, now they expect 4.1, 97 basis points versus 1.03. The interesting part there is they're looking for a supersized 50 basis point cut somewhere. So they got 3 meetings left: September, November, December. You'd expect 25 probably at most of these meetings, but maybe there's a 50 somewhere in there. And so that's what people are going to be on the lookout for. The other part that, people look at with this rate path is, where will it go? Where is that neutral rate? And Philadelphia's Fed President Harker also talked a little bit about that from Jackson Hole, talking about around that 3% area, talking about wanting to get started on a process, not just one cut, being methodical about it. So that might lend itself to the idea that they might not skip meetings, but they might not go 50. So I think their path may be set at 25, 20, 20, 25 along that way, but the data can always change that direction.
Great. Now let's just step back for a minute for our less experienced investors. Talk a little bit about rate cuts in general and how they impact the market. So rates go up and certain things historically happen in the market. Rates go down. This is the federal funds rate, the benchmark rate of the Fed. Rates go down and other things tend to happen. So what typically happens in the market when rates go down? Why should investors even care at all? Just give us a little tutorial here.
Yeah, so it's very interesting, and it's a lot more complicated than you might think about what happens when these when the Fed cuts rates. So when you make borrowing cheaper, it makes businesses more profitable. So if I'm a business and I am borrowing at 5%, and now I can borrow at 4%, in assuming everything else economically is the same, there's a high likelihood that I'm going to be able to have better margins and make more money out of this. And people can think about it from their own pocketbook. Like, so when you have a mortgage, or say your mortgage rate is influenced by changes in interest rates, particularly long-term rates, not necessarily short-term rates, but it's all interconnected in one way or another. Your mortgage gets cheaper, so you're going to either able to afford more house, or you have a lower payment, and you can use that money for something else. And this, in turn, can possibly boost economic activity. At the same point, when they're cutting these rates, there's also a reason behind it. And you have to ask yourself, is that reason a problem with the economy? So if you look at what happened when the Fed has started cutting rates, generally, looking at, say, the 14 last rate cycles since 1929, if you look a year out in the S&P 500, 12 of them had up years and 2 of them had down years, which is a decent record. But there's volatility. And since 1970s, about half of the Fed's first rate cuts were followed by declines of more than 20% in the S&P 500 index. So there might be some volatility along the way, but historically over time, the market has fared pretty well. But don't think that just because the Fed's cutting rates that the market should scream higher. And there is a reason why they're cutting rates. That reason may be to get the policy rate back to neutral, which is not necessarily going to be bad for stocks, but it also might be that they're seeing an economic slowdown, and that might be bad for stocks, as it's bad for some of those companies if there is a recession or a slowing economic growth.
Wow, a lot of stuff to watch. Let's talk about, the Fed always talks about how it is data dependent. That's a term they love to use. So we're going to get a Fed meeting in mid-September. We're going to get, as I believe you said, 2 more during the year. They occur roughly every 8 weeks. And the Fed is going to be looking at a stream of data on inflation, on unemployment, things of that nature over that period of time. What do you think the Fed is going to be more likely than not looking at, that investors can look at, and how will that play into their decisions? As you said, 25%, 25 basis point cut, 50% cut, no cut. What are some things that the Fed will look at and that our investors might want to look at as well?
Well, Jerry, I'm going to give you 3 numbers, and there's 3 probably very important dates going forward. And again, that meeting concludes on Wednesday, September 18th. And the first of those is Friday, August 30th coming up. We have core PCE, and that is the favored inflation gauge of the Fed, and that's expected to come in at 2.7%. And it's right on the path. So that will be an important number. But the most important number is going to be September 6th, the jobs data. And again, when I talked about that earlier, their mandate is now shifting a little bit more heavily towards the unemployment. So it used to be in the past year or two that inflation data was more likely to move markets. And any little change could move markets. And now that data is going to be the unemployment data. And if you look at what they're expecting, the economists are expecting the unemployment rate to drop from 4.3% to 4.2%. Claims are expected to rise from 1 to 155 from 114. So they're actually expecting better data in August than they had in July. And the way I would look at that is, like, if that comes in, it makes it very difficult for them to cut 50 basis points if employment's actually improving. So in my guesstimate, you would probably have to see unemployment in this labor data come in worse than it was in July for them to consider something like a 50 basis point rate cut. But at this point, inflation is low enough that even if you had a blowout report, it's probably not going to change their plan to cut at least 25 basis points. They have to bring that rate back to neutral. What it will do, if we have a blowout report and unemployment's amazing, it might change their path for cuts beyond September. How many cuts this year? So you might go from having only 4 cuts to maybe only 3 if it's a blowout number. But that 25% for September is pretty baked in. It's a question, will we get that 50? And I think by September 6th, we'll know one way or another the likelihood within very close of what we're going to get on the 18th. And then the last data that's very important is Wednesday, 11 September, and that's the CPI. And again, this is, the big inflation number we're looking at, 2.9% expected there, core of 3.2.
Great. All right, one more question for me, then we'll get some from the audience. So bottom line, how might investors want to position themselves based on history if we're getting in a rate cut environment? We haven't been in a rate cutting environment since began in 2019, roughly 5 years. We've been in a rising or high level stable environment for about 2 years. So this may be new to some people. What typically happens in a rate cutting environment? What does the market typically do? What does well? What does poorly? Any thoughts on that, Justin?
Yeah, so what you normally see is some rate sensitive sectors do better because they had perhaps done poorly. So you think about stocks like real estate stocks and utilities. These sectors are really beholden to interest rates and how well they do. Now, sometimes that's front run. And you also see, and I looked at some data. You also have to think about, is this a recessionary or non-recessionary cutting cycle? So the market has done about 9% worse when we've had a recession versus a non-recessionary period over a year when we've had these rate cutting cycles. And you've seen, I looked back at 2007, and we saw energy, consumer staples, utilities do really well. These are also very defensive. But we also had a big recession, a big meltdown in stocks. Communication services, consumer discretionary, financials didn't do as well. In 1989, a little bit softer there. We saw financials do poorly, materials do badly, healthcare and consumer staples do well.
All right, great. So we're going to take a question from the audience. Great question. Will this affect semiconductor stocks? Is there any historic things that can be gauged from that? Or is that just too far afield from what they move on?
Yeah, I mean, obviously, and we're going to, this is a great segue into probably our next topic that we're going to talk about Nvidia a little bit is, as much as people think, some of these semiconductors are economy proof, that hasn't really been the case in the past. That they have had some cyclicality to them, and generally, when you have these economic downturns, they don't do as well. And so I think the real question to ask, it's not just about the rate cutting, it's why, and are we going to dip into recession? And if we are going to dip into the recession, these semiconductors are not a place to hide out. But if we do engineer a soft landing, there are a lot of opportunities for these semiconductor companies.
Great. All right, one other question on Powell. Considering the dovish speech from Powell, will we see the traditional September and October market woes and lows be erased? Of course, you don't have a crystal ball, so you can't give us a firm prediction, but any thoughts on that?
Again, I think this really has to, and it might be a little bit out of Powell's hands. So, Powell was dovish, but when Powell goes from being dovish to being feeling, there's two things that can happen. One is he's dovish, but wants to go along this certain path. Economic data deteriorates too fast, and they're seen as behind the curve. That's not going to be good for markets. The other part is the economic data is poor, and they overreact, and they start taking on these big cuts, emergency cuts, these types of things, and they start messaging that they're really worried. At that point, that probably wouldn't be good for markets either. So ultimately, it's not just going to be about these cuts. It's really going to be about the data, and that's why all of our users here are going to really have to be using that Moomoo app to check on this economic data to see what's going on.
Great. Well, we will follow that, and let's move on to the other big story for this week, which is Nvidia earnings. Now, Nvidia, of course, very popular stock, had quite a run up. They will be reporting earnings this week. The market will be watching this, not just for the health of Nvidia, but for the health of the economy, the AI sector, et cetera, et cetera. Let's talk about this. So what are the expectations for Nvidia heading into earnings, Justin?
So, I'll just give you these consensus projections just to give us a start off of what they're expecting. They're expecting 28.7 billion in revenue. That would be an increase of 113% year on year, and in earnings per share of 60 cents, 143% expected increase year on year. So, obviously, some really excellent growth is expected out of this company.
Great. So obviously beyond the headline numbers of earnings per share and sales and things of this nature, what else do you think that investors and analysts will be looking at for this report?
So the number one most important thing for Nvidia on this call, on the earnings call, is going to be their next generation Blackwell chips. There was, reports that this, ramp up to introduce these chips has been delayed. So investors are going to want an update. If there is a delay, if they're a little bit vague on when this is actually going to be released, that might not be good for the stock, even if we see really good headline numbers and headline beats on that revenue and EPS in the quarter. Additionally, I think they're going to look at what the AI spend is looking like from a lot of these top customers, and they'll also look at what the confidence is going forward. What does demand look like for particularly next year? They'll be looking at 2025.
All right, great. And let's talk a little bit about Nvidia. As I mentioned, it's been a big Wall Street darling for some time. What's its year-to-date performance, and how has it historically done? Of course, we get earnings every quarter. In the face of earnings, what historically has happened?
So, Nvidia has done very well. Not only this year, but in years past. It is the best performing stock in the S&P 500 this year. It's up 161% as of the close Friday. Its price earnings multiple on a trailing basis is 75. That puts it right actually in the middle, even though that sounds pretty high. On a forward basis, because of the phenomenal growth, it's not quite as high. It's only about 43.5 on a forward 12-month basis. The recent high in the stock's been about 140, and now we're trading 130. So, the interesting thing, we did see a dip below 100 just a few weeks ago, but people came back in. So it's up, 30%. So the bar is pretty high. So, that 140 is obviously going to be an area people are watching. But most recently, if you look at, outside of Nvidia and you look at the Mag 7, other Mag 7, they haven't done as well. They've been down about an average of 4% the day after earnings.
Okay. And I know you follow options as well. What is the option market telling us now about ahead of Nvidia earnings? Anything going on there?
Yeah, and obviously Moomoo is a great place not only to trade stocks but to trade options as well. And we have a lot of option tools and features that can help us analyze Nvidia, and then obviously you can use this data to facilitate trades. And in terms of the expected move, what you can do is you can look at the 1 week option straddle, and you can kind of calculate what the expected move over the week is going to be, and most of that move will come during the earnings. So the options market's implying an over 9% move, which is just phenomenal. To give you an idea, over the more recent quarters, the average price change has been just under about 7.5%.
Wow, lots going on there. But we talked about Nvidia, of course, has importance not just historically for Nvidia, but for, as we mentioned, the semiconductor stocks, tech stocks, the S&P 500, the NASDAQ composite, NASDAQ 100. So what are we going to look at for possible impacts to the broader market beyond just Nvidia from this report?
And that gets down to the demand, and we talked about that before. It's really about companies that are buying their product. So a lot of these companies are buying their product, and you're not necessarily seeing the results very fast. Although there is a difference there. I'll talk about that in a second. But the economy really matters. And so if companies continue to do well, then they have this money that they can spend in incrementally more for future investments. But if they're starting not to do so well on their earnings, on their margins, they'll cut back some of that future spend. And so this really matters to the economy, how much spending and demand there is. If we see some type of slowing in demand, that could mean that the economy overall is slowing down, because there's just, the amount, it's something like Google, Microsoft, Meta, and Amazon are going to spend 200 billion in capex this year, and AI dominates that build out of their infrastructure, and a lot of that is purchases they're making from Nvidia, and right now that bodes very well from them. But people are going to want to know, it's $200 million this year, how billion this year, how much is it going to be next year, and how much of that is Nvidia going to capture? And again, how fast are these companies seeing these results? So you take companies like Meta that have been leveraging AI to optimize their ad targeting. They're already seeing results that are pretty good very quickly, while other companies like Tesla and full self-driving, it's taking a little longer for these AI investments to hit their bottom line.
Very interesting. Now, of course, we just got the 13F filings recently from the large hedge funds. Did we learn anything from that about what the large hedge funds are doing with NVIDIA? What's going on there?
Yeah, so just to remind people what 13Fs are, and it's really great because the government releases all of this data about hedge fund positionings at the end of every quarter, and Moomoo app aggregates all of this data and presents it to you in a very easy to look at way, and so you can kind of understand what some of these big funds are doing. And everyone, there's people buying and selling Nvidia, but to me, what's interesting of note, if you look at and these are released, they are delayed, so I will tell you, take that with a grain of salt. They come out in mid-August for trades made as late as June 30th. So Stanley Druckenmiller's Duquesne Family Office, David Tepper's Appaloosa Management, Soros, Paul Singer's Elliott Investment Management, they have all either cut or gotten out of their Nvidia positions as of June 30th. Maybe they have gotten back in, but you do see some, big hedge fund names, some very well-known investors that have been exiting their position, and obviously they're not telling you why that is, but it is just something to be aware of, and it's something I am always very interested in. Who's adding, who's subtracting, what do I think of these different investors, and if I have a particular investor that I like, I might put a little bit more weight towards those decisions.
Great. All right. Audience question here. KPG11. Can we learn anything for NVIDIA's rise comparing it to Cisco in the 1990s? Interesting question. Any thoughts there?
Yeah, I mean, people always try to make something fit exactly, and in this case, that's not necessarily the way to do it. What you can look at is, this idea of people getting a little bit ahead of their skis on their investments. Are you, how can you look at a company and say this growth will continue? I mean, like I said, what did I say the growth was on EPS? Like 143% year on year. That is untenable to do, say, for 10 or 20 years in a row, right? Like, the company would probably be able to buy every company in the world, at that point. So at some point, growth has to slow. It's just the law of large numbers. And then the economy changes and all these different things. But if you look at Cisco on a valuation aspect versus Nvidia is probably more, lower, has a lower valuation compared to where Cisco was at its peak. It doesn't mean that it's still not a pretty frothy valuation compared to overall markets, compared to overall stocks. So to me, it really has to go above and beyond in this earnings report to justify that type of valuation. But it is always good to look at, what has happened in the past for markets and stocks. I think looking at individual stocks, it's hard to compare because you're comparing, two different types of companies that made two different types of products in totally different types of environments. But on an overall valuation basis, it is, something you should be looking at. So not necessarily the worst thing to do.
Great. All right. We have to end it there. Market is going to open imminently. Justin Zacks, thank you so much for your thoughts. Everybody, thank you for watching. Of course, we will be following NVIDIA earnings and the Fed and the economic data on the Moomoo app, so check us out every day. I'm Jerry Cronenberg, Director of Financial Content here at Moomoo Technologies Inc. Thanks for watching, everybody. It is 9:30. Markets are open. Have a great investing day. Thanks a lot for watching.